Welcome to the Antero Midstream 2020 fourth quarter earnings conference call. At this time, all participants are in listen-only mode. A brief question and answer session will follow the formal presentation. If anyone should require operator assistance during the conference, please press star zero from your telephone keypad. Please note this conference is being recorded. At this time, I'll turn the conference over to Michael Kennedy, Senior Vice President of Finance. Mr. Kennedy, you may now begin.
Thank you for joining us for Antero Midstream's fourth quarter and full year 2019 investor conference call. We'll spend a few minutes going through the financial and operating highlights, and then we'll open it up for Q&A. I would also like to direct you to the homepage of our website at www.anteromidstream.com, where we've provided a separate earnings call presentation that will be reviewed during today's call. Before we start our comments, I'd first like to remind you that during this call, Antero management will make forward-looking statements. Such statements are based on our current judgments regarding factors that will impact the future performance of Antero Resources and Antero Midstream, and are subject to a number of risks and uncertainties, many of which are beyond Antero's control. Actual outcomes and results could materially differ from what is expressed, implied, or forecast in such statements. Today's call may also contain certain non-GAAP financial measures. Please refer to our earnings press release for important disclosures regarding such measures, including reconciliations to the most comparable GAAP financial measures. Joining me on the call today are Paul Rady, Chairman and CEO of Antero Resources and Antero Midstream, and Glenn Warren, President and CFO of Antero Resources and President of Antero Midstream. With that, I'll turn the call over to Paul.
Thanks, Mike. I'd like to start by discussing the 2020 outlook and development plan at AR that supports Antero Midstream's 2020 capital budget and financial guideline. Yesterday, Antero Resources announced a drilling and completion capital budget of $1.15 billion that is expected to generate 9% net production growth in 2020 as compared to 2019. AR's 2020 capital budget utilizes an average of 4 drilling rigs and 3 to 4 completion crews, consistent with 2019 levels. This development program is approximately free cash flow neutral at AR and results in leverage trending toward the mid-2 times range, assuming execution of its previously announced asset sale program. For those that were able to listen into the AR call that we just finished, I highlighted that we remain focused on achieving our cost reduction strategies and achieving our asset sale target at AR. The ability to continue growing production in the current commodity price environment is supported by AR's continued capital efficiencies, liquids-rich focus, and industry-leading hedge portfolio. Let me move to slide number 3 in our investor presentation titled Marcellus Well Cost Reductions, which illustrates the significant momentum in well cost reductions at AR. Last quarter, AR announced a well cost savings initiative that targeted a 15 to 18% reduction in well costs on a per lateral foot basis, or approximately $1.7 million to $2 million per well. The left-hand side of the page illustrates AR's January 2019, so a little over a year ago, well costs of $970 per lateral foot that was assumed in AR's 2019 capital budget. During the fourth quarter of 2019, AR's actual well costs were $840 per lateral foot. This was driven primarily by lower costs for flowback water as AM implemented flowback water blending and localized storage operations. The coordinated effort between AR and AM allowed us to quickly and successfully execute our blending program and deliver savings ahead of schedule. 2020, AR is targeting total well costs of $795 to $825 per lateral foot, driven by expanded flowback water services provided by AM, drilling efficiencies achieved in 2019, and lower fresh water usage in completions that is included in AM's 2020 budget. These savings allow AR to continue actively developing in today's commodity price environment and drive high margin, stable gathering, and processing cash flow growth for AM. Now let's move to slide number 4, titled Well Protected from Near-Term Gas Pricing Weakness. Antero Resources has a long track record of hedging and selling production forward, generating $4.7 billion of hedge gains since 2008. This has resulted in development program stability that we expect to continue in the future. Looking to 2020, AR has hedged 94% of its expected natural gas production at $2.87 per MMBTU, or 42% above current strip pricing. AR is also well hedged in 2021, with 93% of expected natural gas production hedged at $2.80 per MMBTU. In addition to the natural gas hedges detailed on this slide, Antero Resources is 100% hedged on its crude oil and pentane production at approximately $56 per barrel, or 10% above current strip prices. Moving to slide number 5, titled 2020 Capital Budget, this details AM's capital budget for 2020. As depicted on the map on the right-hand side of the page, in 2019, we built the backbone of our midstream infrastructure in Tyler County, West Virginia, that supports the majority of AR's development over the next several years. In 2020, we optimized our capital plan to focus on the highest rate of return locations at AR that are also in close proximity to existing gathering and water infrastructure. This resulted in a capital budget of $300 to $325 million in 2020, or more than a 50% reduction compared to 2019. Since we released our original 2019 capital budget and 2020 target 1 year ago, we have eliminated or deferred almost $400 million of capital in those 2 years combined. This speaks to the just-in-time nature of our investments, visibility into AR's development plan, and AR's success in consolidating acreage through acreage trades that minimize the geographic footprint of AM's infrastructure. Our capital budget for 2020 is focused primarily in the Marcellus and includes our first processing plant at the Smithburg Processing Complex, located just west of Sherwood, or Smithburg 1. As a reminder, the joint venture with MPLX placed Sherwood plants 12 and 13 online during the fourth quarter of 2019. These plants added 400 million cubic feet a day of additional processing capacity, increasing the joint venture's total processing capacity to 1.4 BCF a day. Including the 200 million a day of additional capacity from Smithburg 1, the joint venture will add 600 million cubic feet a day of processing capacity to support liquids-rich production growth for Antero Resources. Looking more granular into 2020, we expect to invest approximately 2/3 of our capital budget in the first half of the year, and the remaining 1/3 in the second half of the year. AM's capital flexibility, in addition to its visibility into AR's development plan, is a competitive advantage for AM. It gives us confidence in the volumetric growth and ability to maintain high asset utilization rates that drive peer-leading returns on our invested capital. Slide number 6, titled Consistency of Returns and Capital Resiliency, illustrates our track record of disciplined capital investment that drives our peer-leading returns on invested capital. The top right chart on the slide depicts our asset utilization, with blue illustrating our compression utilization and gray illustrating our joint venture processing utilization. As you can see, the utilization rates have continued to improve every year since our IPO, and we set company records in 2019 for compression and processing utilization rates of 88% and 98%, respectively. This is a testament to our integrated planning efforts and appropriately sized infrastructure to match AR's visible production growth profile. This just-in-time philosophy has proven to be very resilient over the last several years, where AM has generated an average return on invested capital, or ROIC, of 12% since its IPO in 2014. In 2019, our ability to defer $130 million from our original capital budget allowed us to again deliver a 13% return on invested capital. Looking ahead to 2020, we expect our ROIC to improve further into the mid-teens range. As a company, we remain highly focused on ROIC, but also leverage, per share, cash flow growth, and safety, all of which are metrics in our management and employee compensation plan. Our focus on these metrics, along with our C-Corp structure and independent board, puts AM at the governance forefront of the new midstream infrastructure model. With that, I'll turn the call over to Mike.
Thank you, Paul. I'll begin my AM comments by highlighting the recently announced AM cash dividend of 30.75 cents per share for the fourth quarter. The dividend at AM was the 20th consecutive distribution or dividend paid since the IPO of Antero Midstream Partners in 2014. In addition, during the fourth quarter, we purchased 19.4 million shares from AR. To date, we have repurchased 22.9 million shares for $125 million, resulting in $175 million of remaining capacity under our $300 million share repurchase program. Now let's move on to the fourth quarter operational results, beginning with slide number 7, titled Year-over-Year Midstream Throughput. Starting in the top left portion of the page, low-pressure gathering volumes were 2.6 BCF per day in the fourth quarter, which represents a 1% increase from the prior year quarter. Compression volumes during the quarter averaged 2.4 BCF per day, a 9% increase compared to the prior year. Our 50/50 JV gross processing volumes averaged 1.2 BCF per day, a 51% increase compared to the prior year quarter. Processing capacity was 92% utilized during the quarter. Joint venture gross fractionation volumes averaged 31,000 barrels per day, a 63% increase from the prior year. Fresh water delivery volumes averaged 148,000 barrels per day, a 9% increase over the prior year quarter. Moving on to financial results, adjusted EBITDA for the quarter was $203 million, a 6% increase compared to the prior year quarter. Distributable cash flow for the fourth quarter was $159 million, resulting in a DCF coverage ratio of approximately 1.1 times. Capital expenditures during the quarter were $125 million, or $30 million below the midpoint of our revised guidance range. As a result, full-year capital investments totaled $646 million, or $130 million lower than our original capital budget at the beginning of 2019. This highlights the capital flexibility Paul mentioned in his comments. Moving on to the balance sheet and liquidity, as of December 31st, 2019, Antero Midstream had $960 million drawn on its $2.1 billion revolving credit facility, resulting in $1.2 billion of liquidity. Additionally, AAM's net debt to LTM adjusted EBITDA was 3.5 times at year-end. I'll finish my comments on slide number 8 that summarizes how far we've come as a company since our 2014 IPO. In 2019, we took significant steps to improve our corporate structure and governance, eliminating the GP and IDRs and converting to a C Corp with a board comprised of a majority of independent directors. Looking ahead to 2020, we look to continue to deliver on our organic growth strategy. Despite natural gas prices declining over 50% since 2014, our 2020 adjusted EBITDA guidance of $850 to $900 million represents over a 1,200% increase since our IPO, highlighting the significant growth underpinned by Antero resources. Our capital budget for 2020 of $300 million to $325 million is 44% lower than our 2004 capital expenditures as we leverage our existing infrastructure and drive capital efficiencies. Based on the midpoint of the adjusted EBITDA and capital budget ranges, we expect to generate over $400 million of free cash flow before return of capital in 2020. We expect to transition away from the MLP model of paying out a majority of the cash flows generated to the C Corp model of generating free cash flow after dividends over the next several years as we grow our EBITDA and reduce future capital expenditures. The output of this growth profile and capital discipline is an improving return on invested capital into the mid-teens or higher in the future. This consistent return on invested capital has supported an increase in our return of capital to shareholders by 242% since our IPO, while still maintaining a strong balance sheet with leverage in the mid-3 times range and $1.2 billion of liquidity. In summary, we remain highly focused on capital discipline and generating free cash flow. During sustained periods of low commodity prices, this results in lower AM capital budgets and non-speculative short cycle time investments that still generate high asset utilization rates. This capital flexibility results in an attractive cash flow profile that should drive shareholder value. With that, operator, we're ready to take questions.
Thank you. At this time, we'll be conducting a question and answer session. If you'd like to ask a question, please press star 1 on your telephone keypad, and a confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. One moment, please, while we poll for questions. Thank you. Our first question is from the line of Jeremy Tonet with J.P. Morgan. Please proceed with your questions.
Hey, guys. This is James on for Jeremy. Hey, just looking at the high-pressure gathering fees, they look like they stepped down sequentially and year over year. Maybe I missed this in the K, but what's the driver there for that?
The high-pressure fees stayed the same at 21 cents. We just had some prior period adjustments that we caught up in the fourth quarter, so that's the reason it shows a decline, but the 21 cents is still applicable to high-pressure fees.
Okay, so for 2020, 21 cents would be a good
yeah, 21 cents.
Okay. All right, great. And then just moving to CapEx, what was really the driver for the coming under budget in 4Q19? And then looking out to 2020 as well, what were kind of the biggest cuts in terms of segments for just lower CapEx there?
The lower capital in 2019, we just continue to defer projects and focus on Antero's current development plan, which has become more concentrated in Tyler County, which is where our infrastructure build-out occurred earlier in the year. So just leveraging existing infrastructure. That continues in 2020. On that map, it showed, deferring the Wetzel build out. It's really just focusing on that Tyler County in 2020, and in 21 and 22 having the capital associated with the Wetzel build out.
All right, great. Thanks. That's it for me.
As a reminder, to ask a question today, you may press star 1 from your telephone keypad. Thank you. Our next question is from the line of Greg Brody with Bank of America. Please proceed with your question.
Hey guys, just a few questions for you. Your share repurchase program, how are you thinking about that today, and sort of the cadence of what we should expect this year in terms of how much you think about buying back?
Yeah, so there's still $175 million of purchasing power authorized by the board at AM, just as a reminder. And AM has certainly expressed an interest in repurchasing shares from AR, so that's kind of an ongoing dialogue subject to coming together, on price. I wouldn't anticipate anything in the near term there at these prices, but the sooner you buy in shares, obviously you eliminate those dividends, and it's great for AM. So I think AM will execute on that throughout the year in one fashion or another. It may buy some in the open market as well.
Got it. I think so. In the AR presentation, showed some incremental gathering, processing, and transportation improvements since the end of December. Just wanted to clarify: was any of that at AM, or was it all incremental third party, or non-related third party?
In 2020, that $48 million of it was AM. There was an additional $27 million. It was a total of $75 million from that GP&T that were third parties.
Or third party. And that's some of that was realized after you made the December 9th announcement?
No, that was all December 9th.
The December 9th announcement was $350 million total over 4 years, and $250 of that $350 is AM, is anticipated to be from AM rebates. The rest is other third parties.
Got it. So was there just maybe I know this is an AM call. Was there anything on AR that was incremental then?
There was nothing incremental on that.
No.
Okay. And then it looks like you changed your targeted year-end leverage metrics for year-end. Actually, they're improving a bit versus what you provided on December 9th. Is just it's a slight change. What's driving that?
I think the mid-threes is where we were in December. There hasn't been a material change from that. EBITDA is exactly as we expected, and capital is at the same levels too. So I don't see any change to the announcements that we had in December.
I'm probably being just too literal with the language, so that's helpful. All right, guys, thank you for the time. I appreciate it.
Sure. Thanks, Greg.
Thank you. Our next question is from the line of Sunil Sibal with Seaport Global. Please proceed with your question.
Yeah, hi. Good morning, guys. So a couple of questions for me. First, on the cost reduction side, you guys have done a pretty good job, so far on the AM cost side. I was wondering if there are more levers available to pull for bringing that down further, and how should we be thinking about that?
I would just say, Sunil, that we've got a lot of things always working. They're incremental things, and we just continue to push things lower as we get better and better at all parts, at logistics, at sand supply, at the drilling, and so on, completions, the rate of completions. So it's pretty much the laundry list that you've heard of already, but just continue to make improvements in all of that.
We think there could be more to come at AR. And as far as AM goes, it's really just getting more efficient about planning and logistics and where we're spending capital in front of the drill bit. And as Mike mentioned earlier, it was a bit of concentrating the drill bit more and utilizing existing infrastructure. So that's really what's going on there. I mean, you certainly bid everything out and try to improve on construction costs and all that, but I think this is really more about building what was really needed and could be highly utilized.
Okay, got it. And then one kind of broader question, you highlighted returns on invested capital as an important criteria. I was kind of wondering if you can talk a little bit about your, broader capital allocation policy. And obviously, it seems like, leverage will tick up a bit in 2020, considering all that's going on. What is the kind of leverage target that you guys have in mind ultimately for AM?
Yeah, it's a mid-threes leverage target. Our leverage doesn't inflate going forward. We have, EBITDA growth every year in the high single digits. So you've got cash flow growth and your capital continues to come down. So the leverage stays flat in the mid-3 times range.
And then on the broader capital allocation side, obviously, equity markets don't seem to be rewarding for the dividend payouts. And how do you think about that in terms of, your broader capital allocation philosophy?
Similar, like I mentioned, you've got growing cash flow, capital came down over 50% this year. So your leverage is staying flat in the mid-3 times. It's very attractive for a midstream company. And so at today's dividend rate, assuming holding it flat, you're at 1.1 times. That grows over the next year or two to 1.2 times. And in a couple of years, you actually have free cash flow before return of capital in excess of the dividend. So we don't see any reason right now that the dividend isn't sustained at today's levels.
I think the equity market will come back to the dividend, so to speak. So no need to have a knee-jerk reaction over the last few quarters.
Okay, got it. Thanks, guys.
Thank you.
Our next question is a follow-up from the line of Jeremy Tonet with J.P. Morgan. Please proceed with your questions.
Hi, good afternoon. Thanks for taking another question. Just wanted to see on the processing JV side, it seems like the CapEx pulled back a bit there, or is a bit lighter, I guess, going forward at this point. And just wondering if you could refresh us as far as what you expect, kind of any cadence to new plants or what type of activity for future CapEx we should expect there.
Yeah, we have $30 million in the budget for 20. Paul mentioned we just put on Sherwood 12 and 13 in the fourth quarter, so kind of a pre-build and grow into those processing plants in the first part of the year, and then Smithburg 1 comes on and utilize that in the back half of the year. So we only have $30 million. So invested a lot in those processing plants, and now we have the ability to fill them and then just build a plant or two each year from here on out.
So that still is the current plan then, I guess, building a plant or two per year going forward?
Yeah, that's correct.
Got it. And then maybe I'm looking at this too finely here, but it looked like for AR's lateral length, it had been kind of coming in recently and was a bit shorter in subsequent quarters over the course of 19. And I think the guide you laid out here talks about 12,000-foot lateral. So just wondering if there's any kind of shift here that we would expect.
No, there's no shift. I mean, just when you look at the 20 plan for Antero, the completions average 11,400 feet. The drilling average is like over 12,500 feet or around that. So it's just timing. And there's still trying to drill longer laterals, and our type well is a 12,000-foot lateral well.
Got it. Great. And maybe just the last one, if I could, sound like the current dividend level you're looking to sustain here, didn't want to have a knee-jerk reaction to the market, but is there a certain length of time where if things don't change, you might, kind of reevaluate the approach here, given kind of the elevated yield, or any other thoughts that you could share on that?
Yeah, no thoughts to share on that. That's something the board discusses over time, but no inside thoughts there. No.
Got it. That's it for me. Thank you.
Thank you. Thanks, Jeremy.
Our next question is from the line of Ned Baramoff with Wells Fargo. Please proceed with your questions.
Hi, thanks for taking the question. Just one from me. Could you maybe provide an update on your discussions with Veolia regarding the idled Clearwater facility? And then as part of that, are there any other expenses related to the idling of the plant expected in 2020? Thank you.
Yeah, what we can say is that discussions continue with Veolia, and that's about all we can say. We can't comment further. But and then on the
no material expenses going forward.
Yeah, no material expenses. It's been mothballed.
Thank you.
No, thank you, Ned.
Thank you. At this time, I'll turn the floor back to management for further remarks.
Thank you for joining us on our conference call today. If you have any further questions, please feel free to reach out to us. Thanks again.
This concludes today's conference. You may disconnect your lines at this time. Thank you for your participation.